Hey ballers, this episode is about self-storage investing. I've got a real OG in the house, Scott Meyers, with over 30 years of experience and 28,000 units in management nationwide. Scott's experience and insights are unmatched. Today, we're talking about why he made the pivot to self-storage, how he built a portfolio in a niche that is now booming, and whether it's too late for you to get in. So if you've been thinking about branching out or scaling your business, this episode is a must listen. Hey, it's V Lee and you are watching the Real Estate Baller Show. If you enjoy our video and found value in this channel, please do me a quick favor and hit that subscribe button. It helps us more than you know and allows us to help more people achieve financial freedom through real estate investing. Thank you and enjoy the episode.
I'm sorry for this interruption. I've been asked a lot about passive investment, and I understand that there is nothing passive about being a landlord unless you can find a great property management company. So if you own an Airbnb, a vacation rental, or a short-term rental, and you are looking to free up your time, contact our team at Buzz Vacation Rentals at 281-549-8432 or check out our website at www.buzzvacationrentals.com. Thank you, and back to the Real Estate Baller Show. This episode is brought to you by Jet Lending. For over 20 years, Jet Lending has been helping real estate investors succeed. They offer 100% financing so you can be in at $0 at closing. I can always count on Jet Lending to fund my deals. If you're looking to fund your next deal, contact our friend over at jetlending.com. This episode is brought to you by National Real Estate Insurance Group, a national independent insurance agency specifically for real estate investors. I personally use NREIG for my investment properties. They offer a low monthly payment option to help you to lower your cash out of pocket when buying an investment property. If you're looking for insurance coverage for your flips or your rental, reach out to them. You can click on the link in the show descriptions, or you can reach out to Jules at 816-946-8443. All right. Hey, Scott Meyer. Welcome to the Real Estate Baller Show. We got you another celebrity on today. Maybe tell the audience a little bit about yourself.
Hi, V. Well, good to see you again, and thanks for calling me a celebrity. I certainly don't consider myself a celebrity, but I am the OG in self-storage, and I've been at this for, I've been in real estate now for approaching 31 years, and been in self-storage for 20 years of that. Started out in single-family homes and multifamily, did some office buildings, did some warehouses, parking lots. And once I bought my first self-storage facility, I never turned back, and I absolutely love this asset class. We had about 75 single-family houses and about a little over 420 multifamily units. And what I just didn't care for at the end when we decided to make the switch, V, is that I recognized a few things. And one is that I was growing less loving of my fellow man and woman because they were lying to me and stealing from me so much that I thought I better change my professions before I become a very cynical and just a grumpy old man. And then the second piece is just when you look at the business models and you compare the two, self-storage just hands down, it just outperforms all other asset classes. When my wife and I decided that, hey, this isn't fun anymore, we don't have the free time that we thought we would have, and we certainly don't have the ancillary income that we thought that we would have just because of the damages and the courts siding with the tenants over and over and over again. We began to look at the other asset classes, and I don't think in the beginning nobody looks for self-storage because it's nothing sexy. It's nothing that you brag about to your friends or business associates, but it's a solid, predictable business model that just churns out cash, and it doesn't need to be sexy. We were at the place where we just wanted a solid business model so we could have a lifestyle that we wanted. So we made the pivot, bought our first self-storage facility, and I never looked back, sold all the houses, sold the apartments, and now
What year did you buy your first facility?
Yeah, 2005 was when we bought the first one, and then The second, the third, and the fourth came very quickly right after that, within just a few months of each other. And then we put all the houses up for sale. We sold them off in 3 chunks and then sold each of the apartment complexes. And now we develop, we build from the ground up. We convert grocery stores, industrial buildings, any type of building that we can into self-storage. And of course, we continue to buy and acquire self-storage facilities, and we do it all across the country. And we got a little over 5 million square feet now, and approaching 30,000 units total right now. And very active in capital raising and syndication and bringing in private equity into our projects. That has fueled our growth. And we are just super excited about the place that we're at right now with where the economy is headed, because self-storage always does well during a downturn or a recession. Even if interest rates are beginning to improve, that's only good news for us, no matter where we're at.
Yeah, it's amazing that you make the transitions from single-family home to self-storage. I feel like most of us start in the single-family home, and some of us stay there forever, and some transition into another path. When you make that transitions back in 2005, there's not much information about self-storage like there is today. And I feel like it's like today, it got into the spotlight. Years ago, nobody talked about self-storage. What did you see at that point that, make you choose self-storage?
Yeah, you're right. There wasn't too many people teaching it. It was kind of considered the ugly stepchild of commercial real estate, and it didn't get a whole lot of press, except for there were a couple of REITs and a couple of the large companies that were producing their financials on an annual basis. And lo and behold, the self-storage REITs, so there were only 4 at the time, they were outperforming everything else. And so I thought, well, this is probably worth looking into. And so I went to one of the trade shows. There's basically 2 out there, the Self-Storage Association and Inside Self-Storage. And fortunately, they have traveling shows. And so one of them came to Chicago, and I live in Indianapolis. And so I visited that regional show, and my eyes were opened, not necessarily from the show and what they were teaching there, but I was on a mission to speak with as many self-storage investors as I could, other fellow attendees that were at that conference. And I did. I just asked them a few basic questions. How did you get involved in the business? How did you get started in self-storage? What do you like best about it? Well, what don't you like about it? And where do you see the opportunities right now? And after as many people as I could talk to, and even some, if they were friendlier, I have coffee with them, or go out to dinner, or have drinks after a session, and continue the conversation to just glean as much as I could about the industry. And I walked away just recognizing that, wow, first of all, anything that I had maybe a misconception or a myth about the industry was busted after talking to these folks. And there wasn't anybody that was, and I guess maybe not at a conference you would find this, but there weren't too many people that were talking about the downsides or the cons to it. I mean, they had to search to find the reasons why they didn't like the business. And gosh, at the place that I was, with being in knee-deep in the tenant toilet business, the list is a mile long of the things that I didn't like about the business. So
yeah, I can give you, a mile-long list of why we don't love rentals, right?
Exactly. Yeah, everybody loves rental real estate if it weren't for the tenants and toilets. And so that's, I mean, literally, that's where I came to, is we were at that place. And I just said, okay, well, what else is there? It's either parking lots or self-storage, because we just have stuff. And so it turns out the stuff business is a pretty good business, and the model works very, very well. And yeah, we've been able to raise our family and travel all around the world with it, with the free time and the cash that it provides. And it's a very scalable business model, which is much easier to scale than anything else that I've been involved in.
There's so many things that we can unpack here today with your knowledge and experience. But let's focus on something that you said earlier for a minute, because I think some of the audience may be on the verge of transitioning, right? When you decide to get rid of your single family home, and I think you also had multifamily homes at the time, and you decided you want to get rid of them. How did you sell them off one by one? Did you find institutions and just sell them by a portfolio? How long did it take? And were you able to maximize?
Yeah. So when we finally made our decision was after we bought our first facility, and then we were getting ready to buy number 2, then I decided that now that we've got one under our belt, the banks are looking at us seriously. And we were able to get commercial loans on our apartment buildings, but lenders don't like to step out of their comfort zone too much into with a borrower who is starting a new business or going into a different direction as much. But once we had one under our belt, then we established a relationship with not only that bank, but then the others would begin to look at us a little bit differently. So we knew now all we needed to do was find the facilities, and we were able to do that. At the time, there was, I don't want to say low-hanging fruit, but a whole lot of mom and pops that were not managed well that we were marketing to and having conversations with. That there was a lot of opportunity out there that we knew that we needed to focus on two things, and that is finding sellers and then finding the capital for it. And I can't be distracted by the houses and the apartments. And so all the apartments went up for sale, and the houses, we put it up as a portfolio. And we didn't get one person to buy all of them, but there were three separate transactions. So three separate groups bought our 75 houses, and it was almost split 25, 25, 25. I can't remember the exact ratio. That's going back 20 years now. But yeah, we were able to sell all of our multifamily and our single family off by the end of 2006, literally in December of 2006. And so within 2 years, we had the entire single family and our habitational real estate portfolio sold off.
Wow, that's amazing. Okay, so moving forward to today, is it too late to get into the storage game?
Well, I get that question a lot, and I get it a lot because we have an education company as well. As you mentioned, there wasn't, back in 2005, there wasn't a lot of information to learn how to invest in self-storage. And so along the way, we created a real estate education company as well. And well, to date, we're the first and we're the biggest, and we've taught more successful self-storage investors how to get into this industry than anybody else. And so I've heard that question a lot. And as the years go on, the answer is always no, it's not too late, because there's a whole bunch of folks that are fearful that'll never do it. And as a matter of fact, right now, you can never say now is the best time. However, if you wait, it usually, there's a lot of regret that goes with that. And here's why. We're looking at the industry right now as an incredible opportunistic time to buy, because we're at that sweet spot where interest rates are coming down, which means that anything that we buy right now, within maybe 2 years or so, when they're done with these multiple rate cuts, the interest rates will be much lower. The cap rates will be lower, which means the valuations will be higher for our facilities. And so we're on a tear right now. We're on a buying spree. We're on a developing spree, so that we can take advantage and either refinance at that time when the valuations are high, or sell at that time. And then it makes it easier for us to do all things, so to be able to raise capital in order to go to our lenders who are seeing the exact same things, and also knowing that our lenders know that this asset class, self-storage, has the lowest loan default rate and has the lowest loan loss rate. And so they're clamoring for these self-storage facilities to put on their balance sheet. So the funding side for self-storage is very easy. It's not difficult to raise capital or to get a loan for self-storage, because it just, again, it outperforms all other asset classes and has the lowest loan default rate. So our lenders are tripping over each other to get loans out into the market and put these self-storage facilities on their balance sheet. So that is, I don't know if I answered your question. I started to go off there on a tangent, but we feel that now is the best time, and we certainly don't think that you've missed the boat. And you would ask any investor that has been in self-storage for a little while, and they would say that the biggest mistake they ever made was not getting into it sooner. So there is no bad time to get into self-storage.
Yeah, that's amazing, because I feel like, whoever get in first always come out big, right? If you run your business right, obviously.
Right.
Yeah. So you did answer the questions, but I felt like in the last few years, because of the attentions, the return that the storage space get, almost every mom and pop storage facilities have been scooped up by larger companies. So let's say someone looking to get started, where do they even go look for one to buy, and what size, what kind of things should they look for? I would assume that a new investor, new to the storage space, probably wouldn't go buy public storage, right?
No, you wouldn't have the ability to, first of all, and
right.
Probably would be paying too much for it. There's not a whole lot of value add. Those things are optimized. But to your point, without any self-promotion, that's why we started our education company, because when we began to look out there in the landscape, there wasn't anybody teaching us the ways to market them, the ways to underwrite them, the proper ways to run them. And so, we saw an opportunity to create an education company to teach everybody what we had learned by the School of Hard Knocks and just along the way. And so the easy answer is we got to get educated, because I think it would be very simple for somebody who doesn't know about the industry or what the opportunities out there or how to market for them. They may give up and either fall prey to that line of thinking, well, I missed the boat and there's no low-hanging fruit out there anymore. But our students are buying every day, and we have a whole deal pool within our organization, in our ecosystem, where we taught a whole bunch of folks how to go out and find these facilities, and if it's too far away or too big or too small, it goes into our deal vault, and our community gets to share in those projects. And so there's plenty of opportunities out there. The REITs are building, the big boys, they're building and they're buying bigger facilities. And the regional players and the national players, they're buying some of these smaller ones, but they're buying them in groups. And so that is a strategy, and that's one that we use as well, is that you can go out and buy and find a facility on your own. That's easy. Many folks are then buying 2, 3, or 4, either to hold for their own, but the ultimate goal would be to 5, 7, 10 years down the road to then sell them to the bigger player, to the regional player, somebody in town that has another 3 or 4 and they want to buy your 3 or 4, or the national player that wants to come into that market, into your market, and they find a great way to enter is to buy the 5 facilities that you own. And that gives you the higher multiples, it gives you the lower cap rates, and just makes it easier and more profitable to sell. So the opportunities are out there. You just need to get educated. And again, that's what we're here for. That's what we do. We produce self-storage millionaires.
How do you classify a small, medium, large facility? Like, what's the number of units?
Yeah, that isn't a number that you would see people really looking at. People more so look at a class A, B, or C, and that usually is a function of the size of the facility as well as the market that it's in. So a class A facility, for instance, is going to be 400 to 800, 900 units. It's going to be close to 80 to 100,000 square feet, and it's going to be in a major metropolitan statistical area within the MSA. 3 stories, climate control, all the bells and whistles, professionally run, third-party management company or a REIT. That is, what they look like when you see them. They're shiny, they're gleaming, and they are the best of the best. A Class B it may be multi-story, but typically it's single-story, or they may have some climate control units as well. It is paved. It could be gravel, but it's in a secondary market, so it's just outside of the MSA. It's got gates and security, and maybe there's an employee behind who's not a corporate person, but a very professional person that's dressed well and speaks well, running the facility. Maybe a little bit smaller. It may be in that 250 unit to 400 unit range, and that would be considered a Class B facility. And then a Class C, a little bit smaller. It's going to be anywhere from, you could call it a self-storage facility, even if it has 10 units or so. It could be just one building, but typically for what we're investing in, anywhere from 50, 75 on the very, very low end on up to that 100, 150, 200 unit facility. It's in the tertiary market, so third-tier markets. It may have a kiosk. It may not have anybody in the office at all. Or if it does have somebody in the office, it may be the owner, or it may be the owner's relative that isn't very well trained or very well versed in the business. It may be gravel. It may be paved. It may be dirt. It may have a fence around it and security system, or it may have none at all. It could be older, first generation, built in the 70s or 80s. Again, a Class C facility, when you see it, a Class A, it's kind of hard to determine a Class B necessarily. But that's a spectrum. We don't look so much to the size, but really the size and the quality and the market that it's located in.
So when you come across a unit, a facility, not a unit, how do you underwrite?
Well, we do multiple revisions and ways in which we underwrite them. So there's the proverbial back of the napkin math, depending upon the numbers that we have from a seller or a broker. Hopefully we have some basics. Then it's as simple as determining what the NOI is, the income minus the expenses, all in, giving you your net operating income. And then based upon whether it's a Class A, B, or C facility, then apply the appropriate cap rate to it for that market and times that we're in, depending upon interest rates. Now, that's the first blush to see if you're interested and match that up against the acquisition price or the asking price. Next is if we are very serious about a facility and either we're under letter of intent, or if the broker and or seller are willing to give us most of the financials of P&L per se for the past 12 months and a unit mix, then we can do pretty much a full underwriting on the project. And that is by way of our software. It's you could say it's fairly sophisticated. It's got about 150 or 160 different calculations, most of which we use about 20, 25. But once we include the data there, then it's just building out. It's a matter of building out our capital stack. What is our cost of capital? Are we bringing in private equity? Are we putting our own cash in? Where's the money coming from? And then what is the ROI? Does it pencil out, given the income that it is producing, the net operating income, and the asking price, and then how much it's going to cost us to fund this? What is the profit on it? And is that profit enough to then bring in private equity? Is it enticing enough to give them the returns that they are seeking in the marketplace in exchange for being in second position in that equity position on the capital stack, which being just below the loan. So there's a whole lot more that goes into that, obviously, but those are the first pieces, the first steps to the underwriting process.
So can I underwrite it on a piece of napkin?
Well, I wouldn't buy it based upon that, put it that way. But you at least know whether you're interested or not on the back of a napkin. But no, we don't teach any of our students. And certainly you know that I would never condone anyone doing that.
So with that said, what do you stay away from during your underwriting process of a facility? What do you stay away from?
Well, I want to be cautious here, because the way that I buy and what we buy is going to be dramatically different from somebody that's just starting out. So for us, the goal is just as we mentioned, we would like to have institutional grade facilities that are attractive to institutional grade investors down the road. So if we're building or buying something, we certainly would like the ability to, if it's not at least 60,000 square feet right now, that we can expand and get it to 60,000. So if it's a 4-acre parcel and there's only buildings on 3 acres, if we can build that out and get it up to that place where it's 60, 70,000 square foot, that is what institutional investors are looking for. If we're going to develop a facility, it's going to be closer to the 80 to 100,000 square feet. Those are the things that we're looking for. And so when you say, what am I not looking for? It's small facilities in rural areas in those third-tier markets, because we want a bigger pool of buyers, so we're going to pay more money and we're going to get a higher yield and a higher return when we sell, if we're in those second-tier markets or in the primary markets or the MSAs of the major cities. And we have to have the ability, there has to be movement in the market, meaning when people are moving, hopefully growing, the city is growing, they're moving in, that is a big piece for us. Rental rates have to be able to support our acquisition cost or development cost, and that usually is a function of the demand, and so there has to be demand. What is a hard stop no for us is when we evaluate in the market for a self-storage facility is really about 3 to 5 miles. For the most part, we're focusing on that 3-mile trade area. And so we're going to look at the supply index, which means the supply of competitive space, the amount of square footage of self-storage by our competitors in that market compared to our site and compared to the population. So if the equilibrium in the country right now is, depending upon what statistic you look for, is somewhere around 7 to 7.5 square feet per person or per capita. So if we're looking at a facility and we draw a 3-mile ring around it, and that we see that there is 10 square feet of self-storage per person, well, we may be getting into that place where it may be oversupplied. But we'll have to look at the demand and look at the facilities to see, are they full? Are they out of units? Are they raising rates? Because there could be a higher demand in that market. It could, like Florida, has no basements and 0 lot lines. And so 10 square foot per capita, well, that's about equilibrium for that market in a particular city. But if we look at the market, draw a 3-mile ring around a site, a facility, and we determine that there's only 4 square feet of self-storage per person, per capita, well, it doesn't always smell a home run, but that's exactly what we'd like to see, is an undersupplied market. And then we'll go to the zoning office to see if there are any other developments that are coming. Are there any permits being pulled, any new construction coming for storage, if we're going to have new competitors? And at the same time, are there more multifamily? Are there more subdivisions? Is there residential coming in? Is there going to be growth in this market? So those are all things to consider when we're looking at a market and looking at a particular facility.
I miss storage back in the day. Years ago, you go to a place and you talk to a lady in the front, you get a rate, and it stay that way until you move out, right?
Yep.
And earlier or late last year, I decided to go travel. So I put my house up for rent. And obviously I was in the market for a storage unit. And that's when I learned that prices change. The price change constantly. So do you guys use a dynamic pricing software, or with you managing 28,000, is it 28,000 units?
Yeah.
I imagine you have somebody like an assets manager to go and just move the rates around daily. How does that work?
Yeah. Well, first of all, I'm like you. I miss the days when people would move in and the price would stay the same until they moved out, because those are the facilities that we buy, because those people are managing their facilities very well. But yes, on our end, once we own it, we do have a dynamic pricing model, and we do have software that is demand sensitive and sets the rates up for us. So it's literally a flip of a switch within the software. It's just a toggle that you click on, and it goes out and it sets the rates based upon the demand in the marketplace. Now there is some manual work to that, because what we're seeing in some of the markets, especially now, is that what is somebody's promotional rate, their internet rate, much like the airlines, is a little bit different than what the true rate is and what it's going to be. So I don't know if this is what you experience, but when you move in, there's a special 50% off, 75% off, or 1 month free, whatever that looks like. But especially if it's a lower rate, but then you find out, or if you didn't ask, you didn't know what their true street rate is or what it's going to go up to. You might have moved in for $50, but then 3 months down the road, it goes up to $200 because that is the normal rate. That's the normal price. And you see that it truly is the normal price in the market. You just didn't expect that or see that coming. And
That's
so
exactly my experience.
Yeah,
so I
see?
signed a contract and I went home and I read it and I was like, oh my God.
yeah. And unfortunately, and that's not a practice that we employ. We don't discount the rates that heavily. We may offer a 50% off or a 1 month free, but yes, there are some folks out there, some companies that are coming in with a very steep discount and then raising rates 50 to 100% or more just a few months down the road. And unfortunately, what that is doing is that is giving our industry a bad name. And some of these folks some of the people that have been on the receiving end of those rate increases then got together and called their local news station and talked about the big bad self-storage facility and owners over here that are doing this. And it's some unwanted attention, and probably rightfully so. It's not a tactic that we at our company that we employ just because that's not the way that we operate. You can achieve the same thing just by offering a month free, but then showing them what the rate's going to be no matter what.
Right. Yes. Because you're absolutely right. Like was $5 for month one, and then it go up, and then it keeps going up after that with no cap. And I just couldn't tolerate it.
Well, from an investor standpoint, as long as you're not being egregious and taking advantage of a situation, the beauty of self-storage is that we have month-to-month contracts. And so we do have the ability to raise rates. We don't have to wait for a year. We can do it at 7 months or 9 months. If we're getting full and the rest of the market is full, then we may be able to push out a rate increase and not have a mass exodus. And sometimes they're just nuisance rate increases, as we call them, where it's just $2 or $3. Nobody's going to move for that. But that's where the market is, and that's what the demand looks like. And so everybody's raising the rates by a little bit. And so we have the ability that we can raise rates just to keep up with the competition. And sometimes we are the ones that are setting the price.
Yes, but that's where I actually that's what got my attention, to learn more about storage. Prior to it, I was ignorant to the growth of the storage space. And just imagine if we can just keep increasing rent in a single family home. Wouldn't that be awesome?
Yeah, but he can't, unfortunately.
But we can't. Okay, so what was the most challenging deals that you've done?
There's just not a ton of risk, and there's just not a whole lot of potential pitfalls in storage compared to the other asset classes. But there is one. I'll just leave the name of the city out. But we looked at this facility, and it was an acquisition. It was a turnaround project. And a distressed seller was getting ready to leave, and we had to replace a roof, and they hadn't raised rates in a while. I mean, we had nowhere to go but up in this facility. We were going to replace all the doors because they were first-generation doors, but it was cinder block buildings, very solid, just a small site with the ability to maybe expand by buying a lot next door. Well, we looked at the rates and where the market was going, and we saw that there was a lot of growth coming. There was a new manufacturing facility coming in down the road. There was planned residential neighborhoods coming in right nearby. All of this, it was right on this major road where all this expansion was occurring between the next town. This was on the south side of town, and it was all expanding towards the north side of the next town on this U.S. highway, divided highway that our facility was on, with a huge traffic count. So we bought it. We replaced the roof, and we replaced all the doors, cleaned it all up, do all the things that we do. And then it all fell apart, meaning the plant didn't come to town, the residential didn't take off. All this planned development that was coming in just south of our facility, like almost literally next door on down, all of it went to the town down the road. That mayor or that town did a better job of wooing all the jobs and development and everything down there. And unfortunately, none of it happened at our site. And so we sat there, and our rates, we could increase a little bit, but it wasn't anywhere near what we had anticipated. And so we didn't lose any money. We just didn't, we thought most of our projects we go into, we need to double our money. And that's how we measure the profit and whether our time was well spent on this. And we didn't double our money on this project, but Our investors all made money. We made money. We get out a little bit later than we thought, and it just didn't turn out to be as lucrative. But it was a solid single, and we probably had to bunt and then run to first base is what we had to do. But it wasn't the grand slam home run that we had expected when we got into it.
Yeah, so there's always those external factors that we just can't control, right?
Mm-hmm. Yep.
When you say you try to double your money, sorry, Scott, did you want to finish your thought there?
Nope, that was it.
Okay, so when you try to double your money, what time period is that?
Yeah, 5 years at the outset. So if it costs us $4 million to develop a facility, once we get it built and then stabilized, we'd like to be selling it for $8 million. If we buy something for $2.5 million, we'd like to be selling it for $5 million. However you want to slice it. If we're able to double the value within 5 years, that is the goal.
What do you prefer, a build or renovate? Yeah,
so there's really 3 practices that we utilize, all 3 in our company, and that is you can build from the ground up. And the beauty of that is that is the ultimate in creating value in real estate. If you start with a piece of dirt and then you put a building on it, it increases the value, and then you put an income stream inside of those buildings, that's how you create the most value. Buying an existing facility is a little more difficult, but it has to be, you have to buy it cheap. It has to have a lot of upside. So maybe it's high vacancy. Maybe they haven't raised the rates in 10 years, as we just talked about, or they haven't added renter's insurance, or selling locks, boxes, moving supplies, and they don't have a truck rental dealership or agency out front. All those things that we do to increase the value that we can do, and we like that because there's an income stream in place already that allows us to get the loan to buy the facility, and then we can add on after that. But our favorite is the hybrid. It's in between. It's a conversion, which is buying these old warehouses, grocery stores, industrial buildings, where we get the shell for pennies on the dollar. It's already built. The zoning's in place. We don't have to wait for the city and approval from the zoning board. But then we go and build out and fit out the inside with sometimes, most of the time, if we can, we're adding a mezzanine, either a second story or a second story and a third story. And then doubling or tripling the net rentable square foot inside of the building, adding elevators to it. And then once we get those stabilized, that nets us usually a little bit more than a ground-up development, typically way more than an acquisition, and we can do it in a shorter time frame because we already start without having to go through the zoning and approval process, and we've already got the shell in place.
So when you purchase an existing, you said a supermarket,
mm-hmm.
So a typical supermarket would already have AC in place. Do you then convert them to all AC air conditioned units? Mm-hmm.
Yeah, all the buildings, the multi-story that we build and any conversions, they're all temperature controlled. And so depending upon where they're at in the country, we heat them and cool them. And usually we can't use those systems. Sometimes we can use a little bit of them, but they're just because of the ductwork and the size of them, we have to push air through 3 floors and do it a little bit differently. And so we're typically going in with our own HVAC system.
I would imagine that you guys are very efficient at what you do. So how do you assess and improve your operational, keep your costs low, keep your rate high?
I think it's, from a construction and conversion standpoint, we have a handful of contractors, general contractors, project manager companies and subs that we work with and suppliers that we're frequent flyer. We have frequent flyer miles with them. And in other words, we get discounts because we do so much business with them. So that's one way to keep the cost down on the development side and the acquisition and conversion side. As far as operations, that is not my forte, but we've got the best people in place to monitor the rates and ahead of time set a proper budget, proper marketing strategy to be able to make sure that we capture all the eyeballs of people that are looking for storage in that market, and we're marketing in the right places and not overspending in our marketing budget. And then just operating as efficiently as possible and just keeping those expenses down by way of utilizing as much technology as possible so that our payroll isn't as high, keeping an eye on property taxes and mitigating those, doing cost segregation studies, as well as doing a few different things that we can do on the front end with the acquisition and splitting up the building and the goodwill to save on property taxes. And it's just a whole lot of little things. We do have a closing and transition checklist that has over 250 items on it, things that we're going to do prior to and once we buy it to make sure that we're just driving to the bottom line.
So what are the top 3 amenities or features that every facility must have in your portfolio?
Yeah, when people are looking initially, or what they're attracted to when they find us on their phone or whether they're searching on their laptop, when they reach our site, clean, safe, and secure. That's the main thing. So they want to see nice, shiny, gleaming, place to store their stuff. Not that it matters because it's just stuff, and the stuff doesn't care what school zone it's in or if there's a pool out back or anything else. But they like to know that it's in a very clean building, that it's well lit, that it's their stuff is going to be safe, and they're going to be safe if they're going in and out of the facility. So having 24-hour access by way of a key fob once you are in and have a unit there, that there may be security on site, that we have digital video recording systems and a full-blown security system in case after hours if somebody isn't there, a security guard, that their items are watched. Having the ease of being able to get in and out by way of a key fob, a gate code, and getting into their unit, that seems to be key as well. So all those things that just make the customer experience really easy, seamless, and attractive. That's what these folks are looking for. Clean, safe, secure site.
All right, let's talk about something fun.
All right.
I'm sure you got tons of stories. I mean, having that many units, you got to have people that didn't pay and where you got to seize the stuff inside. What are some of the fun stuff that you've gotten?
Yeah, I wish I had some stories. I'm sure that our managers and some of our auctioneers do, but I don't get a lot of those, and we don't have a lot of those. There are a couple of instances where one of my facilities that I don't own any longer, it was located over in a part here of town here in Indianapolis where all the drag racing teams are located. The NHRA drag racing teams, they're all located over towards the track is, and where they hold the U.S. Nationals, and so they're just headquartered here in Indianapolis. And so one of the units went up for auction. They didn't pay, and it was on one of the racing companies. And I happened to be there that day and opened up the unit. We know who's there, but we never know what's inside of it. And we saw these racing parts, and then all of a sudden it was the owner that of the unit that showed up and paid. He had to buy it. If he'd have just paid his bill, he would have bought it. He would have saved a whole heck of a lot of money because it's started getting bid up. But there were engines in there, and there were body parts and everything else. And I have the ability to, even as an owner, to be able to bid on those. And I was salivating when I saw that. So I missed out. There was also another one. Somebody did buy a couple of units. One was filled with racing bikes, old antique vintage road racing bikes that somebody walked away with for a song. And there was another one that had a lot of photo equipment in it that was worth tens of thousands. Some of these people, even though we say, don't put anything in here that's worth more than $5,000, we force them to buy insurance anyways, but it's just a good practice. But there's some of these auctions where some folks have put some very, very expensive and very valuable items inside of these units that we've seen go through auction. Some tool auctions that were not tool auctions, but units that went off at auction that had a lot of tools in it. And but no, we haven't been unpleasantly surprised. No dead bodies or meth labs or anything like that showing up. So it's a pretty boring business.
Bummer.
The exciting ones. Well, the exciting ones are on TV, but you also have to ask, how did those guys get so lucky that all those exciting ones end up on television?
That's right. Yeah.
Perhaps it may not be. Reality TV isn't always real, but yeah, we can talk about that in another podcast.
Isn't that the truth? Okay, so Scott, what would you today, Scott, have? What advice would you have for your 18-year-old Scott?
Wow, that's a good one. Dude, you don't know the half of what you think you know about life. Not even close. How's that for starters? And get a mentor. Don't try to always figure everything out on your own. You need a mentor, and to be open to partnerships. Yeah, that too. And learn the numbers. Don't shy away from the numbers. Dig into and lean into the financials and real estate math. Don't rely on other people or rely on the brokers or sellers or anybody else to give you the math when it comes down to making a decision on a property. You need to understand and know the math. How's that for starters?
Oh, those are good advice. I'm not sure if your 18-year-old would listen, though.
I know, that's just it. But I don't know. Maybe I'd yell at him and tell him. Maybe you would listen then.
All right. Here's my last question for the day. How does the audience get in touch with you?
That's easy. SelfStorageInvesting.com. SelfStorageInvesting.com. That is the nation's resource for learning anything and all things about self-storage. So we got lots of free tips and videos, advice, lots of pull downs to get you started. And of course, that's where you find out all the information on our live 3-day academies. This is the 3-day event that we've been running for the past 15 years. That again has produced more self-storage millionaires than anybody or anywhere else. So you can take it from the OG, myself, but it is my team that is leading that. And if you want to if you're serious about getting started in self-storage, this isn't a rah-rah event. This is a workshop. This is you dig in and you learn how to underwrite. You learn the proper ways to put together a partnership, and you learn how to find and evaluate, purchase, and manage self-storage facilities. And we cram it all into 3 days. So that, as well as for the folks out there that are more savvy and they're looking to grow and scale a self-storage business, then you can find out information about our mastermind as well. So we do have the nation's first and the largest mastermind where folks are growing and scaling their businesses and sharing and trading deals inside of that as well. And of course, if you want to be a passive investor and be one of our equity partners and also get the benefits of owning a facility without taking on the debt risk or the credit risk or the lease up or construction risk, then come alongside and invest with us, and we'll show you the ropes that way, and you earn while you learn as well.
Wow, what an episode. Scott really brought the good today, breaking down the ins and outs of self-storage investing, sharing the stories of his transition from single-family home and multi-family properties to dominating the storage industry. So remember, whether it's scaling your portfolio or getting into a new asset class such as storage unit, your next level is waiting. Team up, level up. That's REBallers. Don't forget to like, subscribe, and hit that notification bell so you'll never miss an update from us. Thanks for joining us, and we'll see you in the next episode.